The past couple of weeks have been full of news headlines about the next bank to collapse. Even though some of this news is hysteria, there might be another bank that might end up on the chopping block, even though a lot of the mainstream media isn't covering it. Hey everyone, it's Jonathan here. So let's talk about how Ally Bank might be the next victim of the Fed's fight against inflation. So I think the best place for us to start is to talk about how banks work in general. So generally speaking, usually deposit money into a bank. And the bank will take that money and they'll make a variety of different investments. But some of the more common investments they may buy bonds, they may hold your money as cash, or they may use your money to issue out loans. And there's risk with all three of these options. So when it comes to bonds, the biggest risk that you have is interest rate risk. And pretty much what that is that let's say you buy a 2-year US government treasury and it yields you 2%. And then 5 months later, that same 2-year treasury is now yielding 5%. Well, what happens is that the bond that you bought at 2% is now worth a lot less because there's now bonds for the same amount of time with the same amount of risk per se, but it yields a lot more than what your bond yielded. Another risk you have with bonds is something called duration risk. The longer your payback term is, the more susceptible it is to changes in interest rates. So for example, a bond that has a term length of 2 years is a lot less sensitive to interest rate changes than one that has a 30-year term. And the reason why is because of the period that you're locking up your money in. There's a lot more opportunity costs when rates change when you have a much longer time before you get your money back. And these are both very important to understand for what we're going to talk about later on in this video. So when it comes to cash, really the biggest risk you have is opportunity cost. Pretty much what opportunity cost is just like, oh, well, I could have invested in this bond that pays me 2% every year versus just holding cash and getting absolutely nothing for it. Obviously, most banks, kind of like most other businesses and entities really, even like individual people don't like doing this, but banks don't like it either. But sometimes banks will have cash on hand just as a hedge. A perfect example of this was JP Morgan Chase. They actually held on to more cash than most other banks right before the Fed started hiking rates because they were very bearish on the projections at that time that the Fed would only hike rates to like 2 to 3%. Whereas right now we're literally past 5%. So it worked out well for them. Another risk we have on the loan side is credit risk. And this one is going to be very important for what we're going to talk about later on. But hold on, hang tight. So with loans, you have credit risk. And credit risk is pretty much the risk that the money that you lend out to somebody, they don't pay you back in full. Now, this is a risk you take on anytime you borrow money. Even if you borrow money to like a government entity or a big corporation, well, those entities could go bankrupt. Well, I guess the US government can't go bankrupt because they could just print more money. But if they print more money, then your money's worth less. So it's kind of a toss up there. But anyways, something I did want to mention is that before we move on in this video is that you may hear me say the term note. And pretty much what I mean by note is like another word for loan. If you're like in your mid-20s or older, you probably heard somebody call loans a note before. And that comes from the legal term promissory note. So pretty much the way a promissory note works is that let's say you go to a bank and you want to borrow money. The bank will give you the money that you want to borrow, but you have to sign something called a promissory note. And pretty much what that is that that's you promising that you will pay back this money under these terms, whether that's a certain interest rate, you're going to have a balloon payment at the end of it, or you're going to pay it over time and things like that. So pretty much another way to think about it is like you're pretty much on the other side of a bond transaction because a bond is basically almost the same thing as a note. So let's talk about the auto market because this is going to play a big role in why I believe that Ally Bank is going to have some serious headwinds ahead of them. So let's go all the way back to the start of COVID. So when COVID started, the pandemic caused a lot of people to stay at home. And because of this, there was just naturally less demand for cars. And this led to, obviously because there's less demand for cars, this also led to less auto manufacturing as well. But at the same time, as everyone was locked up at home, the Fed cut interest rates to 0, which made it very easy for people to borrow money and to be able to purchase things. And on top of that, Congress also issued massive amounts of stimulus money to various businesses and individuals. When the economy reopened and people started to go back to work and started to go back to their normal lives, we saw a sharp spike in demand for automobiles. Given the fact that we had not only low interest rates, but also pent-up savings and supply chain disruptions, the supply couldn't keep up with demand. And prices soared on both not only new cars that were very hard to get, but also used cars, just because a lot of people who wanted to buy new cars couldn't find them, so they just went the alternative buying used cars. And I mean, this was pretty much the case with a lot of different things in 2021. So basically, because of the widespread inflation that we had due to the reopening after COVID, it caused the Fed to have to start raising interest rates. And in March of 2022, they started a rate hike cycle, which sent rates from 0 to over 5% in a matter of just a year. And obviously, as these rates went up, it caused increased costs of all debt, whether that was mortgages, auto loans, credit card debt. These increases are expected to lead us to less buying power by consumers, which will hopefully lower prices and hence lower inflation as well. So we've talked about the economy, we've talked about how banks work. Let's kind of narrow down into Ally and talk about what's going on with them. Ally Bank was the largest auto loan lender in 2022, and they make up almost about 6% of the auto lending market. And when it comes to the auto lending market, there isn't a lot of selling of debt to different parties. So to give you a good example of this, generally speaking, when you get a home mortgage, there's a very high chance that whoever issued that mortgage to you, whether it was a bank or something like that, they'll probably take your mortgage and sell it off to somebody else. Normally the way it's done is that they'll just get your mortgage and find a bunch of other mortgages with people who have similar credit profiles. They'll bundle it up together and they'll sell it off to some like pension fund or the Federal Reserve, some other people who have huge wads of money to buy these things. And they're called mortgage-backed securities. And the thing about it is that in the auto market, that there's not really a whole lot of this buying and selling of auto debt. So because of this, Ally tends to hold a lot of the loans that they make when it comes to automobiles, and they tend to hold it in-house, which actually can be beneficial to their bottom line if they are able to collect on these loans. But if these loans, for whatever reason, were to fail, they probably wouldn't be very beneficial to Ally. They'll probably actually be detrimental. But we'll talk about that more later on. So we know that repos aren't a good thing, right? At least not if you're holding car notes. Well, according to Fitch Ratings, when they have a index for 60-day auto delinquencies, and that number has spiked significantly over the past couple of years. Back in May of 2021, that rate of people who were 60 days late on their auto payments was at 2.5%. Just this January of 2023, that number has moved all the way up to 6%. And this is in comparison to 2009 peak at about 5% during the middle of the Great Financial Crisis. So this isn't boding very well for anybody who's holding notes that are secured by automobiles. So pretty much, let's say I'm the bank, I issue you money so you could go buy your car, and then I get a promissory note from you. Well, then let's say you don't pay on the car. Well, then now I have to repossess on the car because you didn't follow the guidelines of the promissory note. So now guess what I'm going to do as a bank? Well, obviously the bank doesn't want to have a pile up of cars. And like we've seen here, the number of delinquencies are rising very quickly. So that means that the bank's going to have to take on more and more cars. Well, then the bank, what they're going to do is they're going to go take those cars and then sell them. What we're seeing now is we're seeing that car prices are softening across the board. So when we look at the CPI report, we've seen that used car prices have fallen for the past 8 months straight. As encouraging as that is for people who are in the market for cars, it's not a good thing if you're a bank that owns a bunch of notes against something that's losing value very quickly, especially something that historically is known for losing value very quickly. And really, with the CPI report, we've been seeing used car prices not only fall, but we've been seeing it fall much quicker over time. That rate of deflation increased even faster. This is also somewhat confirmed by the Manheim data we're seeing on used cars. It's kind of followed the same downwards path, but over the past couple months, it has reverted back to the ups. But there is a lot of beliefs that this might just be a very, very weird discrepancy in the market. There's a lot of people in the auto market who believe that because Manheim pulls their numbers from auctions and not necessarily actual car sales to consumers, there may be some disconnect kind of between what the dealership is paying for the used car and what they're able to sell it to consumer. And that might be the reason why we see such a discrepancy in the two numbers. And this is a pretty broad-based belief. So it's not just one random person on the internet saying it. There's a lot of people saying it. All of this data that we're seeing kind of ties together into a chart that we saw from FactSet, where they pretty much, what they did is they tried to compare various different banks and see how underwater they are with some of their assets. Or pretty much what a bank asset is, it's usually some kind of debt instrument they have, whether it's a bond that they owned or it's a promissory note that they have. And pretty much what FactSet tried to do is they pretty much try to put it into a table where you can compare the different banks to see which ones more underwater on their assets. Pretty much the equation they used is they got the accumulated other comprehensive income, which is pretty much just the net unrealized holding losses on your available to sell securities. So pretty much, like I said, let's say you have a promissory note that at market value is worth $30,000, but because rates have gone up and you could issue out the same loan for a much higher rate now the value of that $30,000 note might now be like $20,000, let's just say. They got the accumulated other comprehensive income, pretty much AOCI, and they divided it by the bank equity, which is pretty much the bank's net worth, so their assets minus their liabilities, minus the AOCI, as kind of a way to like be able to compare all these different banks that have different balance sheets or different sizes of balance sheets. And they put Silicon Valley Bank, the bank that just recently failed, they did the math out for that bank and it came out to be negative 10.5%. And the bigger the negative is, the worse of a position the bank is when it comes to how underwater they are on their assets. So Silicon Valley Bank was at 10.5%. Guess what Ally Bank was at? Negative 24%, more than double what Silicon Valley Bank was at. And this kind of rhymes with everything I've been saying about the car market and the loans that Ally was issuing. And actually speaking about the loans that Ally was issuing, I actually dug through their recent SEC filing, and we saw that 65% of the auto loans that they were issuing were for used car buyers, which they, in their own 10K filing, even said tend to be less qualified and more risky loans to make. And you have to realize they're making a good chunk of these loans during the peak of the car market. Between 2020 and 2022, they issued about 11% of their total auto loan lending was done during that time. So they have massive exposure to these inflated car prices that we have seen over the past couple of years. So another thing they also mentioned in their 10K was that about 11% of their auto loans were to non-prime borrowers. And these are borrowers who has a credit score of less than 620. And they even mentioned in the report that these borrowers tend to have a significantly higher chance of default. And that was even before considering inflation and rate hikes and the Fed keeping rates higher for longer and all that good stuff. There's a good amount of exposure that this company has to what could end up being very toxic assets. If you remember from the UBS takeover of Credit Suisse, one of the things that really brought down Credit Suisse was toxic assets. What caused Silicon Valley Bank to fold? Toxic assets. You see the theme here? Another thing that we saw in their filing was that their provision for credit losses when it comes to automobile loans from 2021 to 2022 increased 20x. And pretty much what provision for credit losses is that's the bank making a prediction of how many loans they may have to write off as losses just because they get too delinquent or they just believe that they will not get their money back no matter what they do. The big problem isn't necessarily that during a recession, less cars are sold. The big problem is that people who have cars and who have car payments tend to start to default at a much higher rate. If Ally has to repossess those cars, they can't, if they go and try to sell it, they won't get all the money back that they lent out for the car. And the problem is that the money that they're using to make these loans, they're making them using money that people are depositing at their bank. And the thing is, like, if you're a depositor to a bank, you have the right, so like, let's say you go and deposit $100, you have the right to go and get $100. And if you knock on their door and you ask for $100, they have to come up with it. But if they get that $100, lend it out, and then they only get $80 back, well, then they're in a deficit. And if you keep adding more zeros to that deficit, then eventually they're just going to be insolvent. And this is pretty much the basis of my concern of why I think that Ally Bank could have some issues in the near future. Now, do I honestly think Ally Bank is going to go under? The chances of that happening are very slim. But I think I've laid it out pretty well that this is a possibility. And I know a lot of people, they deposit a lot of money at Ally. I know it's kind of like the OG online bank. But if you do have a lot of money on there, you may want to consider this. And if like your whole life savings is on there, I don't know, maybe like if you have less than 250K, then maybe you're fine. But even if your money is protected by FDIC insurance, you have to consider is sometimes it could take a couple of weeks before you can actually get access to that money. So, really for me, I think the biggest thing I could say is that maybe you might want to consider diversifying the banks that you use. Maybe you keep some of your savings here, you keep some of your savings there, just in case one bank fails, you have access to some of your money at least immediately, and you don't have to wait for the FDIC process and all of that. And I think that the biggest thing that would cause a bank like Ally to fail would really be a massive bank run. So like if this starts getting talked about more in mainstream media, then I think this could really actually become a problem when the bank actually now has to realize those losses. Because bank runs are mostly emotionally driven. They're not necessarily logically driven. So personally for me, I actually was a longtime user of Ally. I think I had Ally since like 2013 or 2014. And I think I just recently closed my account like this time last year. And really it was just more because I wanted to consolidate my banking into like a couple of banks just so I like could keep track of everything much easier. For me now, what I did is that a lot of the savings that I have, I put it into like a brokerage account. And now what I'm doing is I'm buying 2-year treasuries and I'm kind of just milking the yield off of that. Now, I will say the yield for a 2-year treasury is very comparable to the yield you can get on Ally. The only problem you have is that the value of treasuries, especially treasury ETFs, move very aggressively day to day. So they move a lot day to day, even though it's not much by like in terms of percentage wise. There is a chance you can lose some of your principal. Whereas in a savings account, that chance is very slim unless if you have more than the FDIC insurance and the bank was to go under. So those are just my thoughts. As always, I appreciate you guys watching all the way to the end. Please like, share, and subscribe, and I'll see you in the next video. Peace.